friends, in this lesson we are going to discuss basic accountancy procedures. Friends, whenever financial statements are prepared by business organizations, they take into consideration certain basic rules. And these basic rules are based on experience, reason, practice and prudence. And these elements are called accounting concepts or accounting conventions. Accounting concepts are basic assumptions or basic conditions. On the other hand, accounting conventions are customs and traditions accepted as guide for accounting. Let us understand this distinction of concepts and conventions clearly. Accounting concepts, they are basic assumptions or basic conditions which must be fulfilled. On the other hand, accounting conventions, they are guiding principles which must be followed. Friends, these concepts are observed at two different stages. One stage is called the recording stage. Let us see what concepts are to be followed, what conventions are to be followed at recording stage. So these conventions, these concepts are cost concepts, then money measurement concept, then business entity concept, then realization concept, then dual aspect concept, and then historical records concept. The second stage at which these are to be observed, that is reporting stage. At reporting stage, which concepts or which conventions are to be followed? First, going concern concept, then matching concept, then accounting period concept, then conservatism concept or conservatism convention, then full disclosure convention or full disclosures concept, then materiality concept or materiality convention, and finally the consistency concept or consistency convention. So these are two different stages. Now we shall discuss these concepts and conventions one by one. So we start with the business entity concept. According to business entity concept, a business enterprise and owner of the business enterprise, they are considered to be two different economic units. They are not to be considered as one. Business enterprise is a separate entity and the owners of that business is a separate entity according to business entity concept. And it is easy to understand in the context of a company and its members. In case of partnership, it becomes little difficult at times to really make a distinction between two. But in case of a company, because the company is a separate legal entity and shareholders or members, they are separate legal entities. Hence, in case of business entity concept, these two persons, the business enterprise, that is a company, and its owners, that is shareholders, they are two different legal people. Like other parties, these such as creditors, such as people who are giving loans, the owners are also a party which is dealing with the business. This means with the business, the owners are also dealing, the creditors who provides goods and services, they are also dealing, the lenders are also dealing. Hence, they are different parties dealing with a business. What is impact of this concept? The impact is that the capital which is contributed by the owners, by the shareholders, is a liability of the business. And the profit earned by the business, that is its liability, because this profit can be withdrawn any time by the owners. And if there is any loss to the business, that loss is recoverable from the promoters. Hence, the loss incurred by the business is asset for the business. So let us be very clear here. The capital contributed by promoters, it is a liability of the business. Profit earned by the business is also liability of the business. Loss incurred by the business, it is asset for the business because it is recoverable from the promoters. Let us now go to the second concept, the concept called going concern concept. Friends, according to this concept, business is a going concern, means a running concern, and it will continue to run for indefinite period. So it is an assumption that the business will continue to run for indefinite period. If a utility of an expense is consumed, it is recorded as expense. If it is not fully consumed, it is recorded as asset. Now since it is a going concern concept, it is possible some expenditure is made that is not fully utilized or that is fully utilized. If it is fully utilized, then it will be recorded as an expenditure. If it is not fully utilized, not fully consumed, it is recorded as asset. What is impact of this concept? The first impact is that fixed assets or assets, these are valued at cost price and not at their market value. So market value may be different in case of a fixed asset and the purchase price may be different. So here the purchase price will be taken for the purpose of valuation of the fixed asset in case of a going concern. In case of current asset, the value will be the cost price or market price, whichever is lower. In other words, we can say if realization price, that is market price, that is lower, then that will be taken for the purpose of valuation. If cost price is lower, then that will be taken as price of the current asset. Depreciation will be charged according to economic life of the fixed asset. So all fixed assets, they have some economic life in terms of years, and the depreciation will be charged according to economic life of the asset. And deferred revenue expenditure is written off over a number of years. Deferred revenue expenditure means an expenditure like advertisement or marketing which will benefit for a number of years. It will not be debited to profit and loss account in 1 year because the concern is a going concern. So deferred revenue expenses, they will be written off over a number of years. It means in installments. Let us now go to next concept, the cost concept. Value of an asset in a business is to be recorded at the price paid when it is acquired. So in case of an asset, which value should be recorded? The value should be that value for which price has been paid when asset was purchased. For example, new machinery purchased for rupees 3 lakh, installation charges paid rupees 0.20, hence cost which shall be recorded in the books of account, it will be 3,20,000. This cost becomes a reference point for all subsequent accounting. Whether depreciation is to be charged, so how much depreciation is to be charged, so this particular cost, it becomes a reference point for subsequent accounting in future. What is impact of this concept? Transactions are recorded at cost of purchase and not at market value or future value. So future value may be more, like in case of a land it happens. Market value it may be more, such as in case of land it happens, or market value or future value may be less also. So transaction will not be recorded at market value or at future value, rather they will be recorded at the price which was paid when these were purchased. Value of items which have no cost, that will not be taken to books. So if some item has been available free of cost, on which no cost has been paid, so that will not be taken into books. Unrealized income, that will not be taken into profit. So these are the impacts of cost concept. Let us now see money measurement concept. Transactions recorded in books must be measurable in money terms. So one aspect is the transaction should be recorded at a price paid. That is cost concept. Another is only those transactions should be recorded in the books of accounts which can be measured in terms of money. For example, purchases, sales, wages, building cost, it can be measured in money. Hence, it can be recorded in business books. What is impact of this concept? The first impact is inflation or deflation. It is not to be taken whenever assets are being valued. Over a time period, it is possible because of inflation, the current value may be different, or because of deflation, the current value may be different, but that value is not to be taken. Second, if no cost has been incurred, item is not to be recorded at all. For example, health of proprietor of the business. It is not to be recorded, although we know it very well that it is very vital to the health of the business. If health of proprietor is all well, he will be in a position to do lot many things for the business. Hence, health of the business is directly related to health of the proprietor. But since health of the proprietor, it cannot be measured in money terms. Hence, the impact of this health cannot be recorded in the books of account. Now, next concept is dual aspect concept. Friends, every transaction has two aspects. One is called debit aspect, another is called credit aspect, and this concept is called dual aspect. Transaction is not complete unless both aspects are complete. This means a debit transaction is not complete unless credit transaction is also complete, or credit transaction is not complete unless debit has already not been completed. It results into creation of liabilities and assets. Because of this concept, the concept of liabilities, the concept of assets, that comes into picture. And this also is known as double entry bookkeeping principle. Machinery purchased for rupees 3 lakh with bank loan of rupees 2 lakh and owner's capital of rupees 1 lakh. In this case, what is liability or what is asset? So an accounting equations comes into picture. Based on this example, the accounting equation will be assets are equal to capital plus liabilities. So value of asset here is rupees 3 lakh, value of capital is rupees 2 lakh here, and value of liabilities is rupees 1 lakh here. And this comes into being as a result of dual aspect concept. And next one is accounting period concept. Friends, performance of a business and wealth change in business, it is evaluated periodically, although business continues to run without this break. So business continues to run without any break, but performance of the business, that is not ascertained every day. The effect of performance on wealth of the business, that also is not ascertained every day. It is evaluated after some time, evaluated periodically. A reasonable period takes into account for this evaluation, and that is called accounting period. In many cases, this evaluation can be done on a yearly basis. This evaluation can be done on half-yearly basis. So that is called accounting period. And it is generally as annual. For most of the businesses, this is annual, but it can be quarterly also, it could be monthly also, it could be half-yearly also for internal purposes. What is impact of this concept? The impact is that balance sheet and profit and loss account is prepared for each year. And this year can be calendar year, this year could be government financial year, government fiscal year. But in most of the cases, for the sake of conveniences, the business organizations, they adopt their annual year as the government financial year and not the calendar year. For internal reporting purpose, this period can be monthly, this can be quarterly, or this could be half yearly also. Revenue or cost relating to that period is taken irrespective whether received or paid or not. So this would depend upon the accounting methods being followed. In accounting concepts, the other concept is called accrual concept. Friends, it is accounting of receipts and payments and recording of transactions as part of and relating to a particular accounting period, irrespective of whether these have actually happened or not. Sometimes what happens, income is received although it has not become due. Expenditure has been incurred although it has not become due. In other words, other situation could be some income has become due but it has not been received, or some expenditure has become due but it has not actually been made. And this concept of accrual, it relates to this part. So it is accounting of receipts and payments and recording of transactions as part of and relating to a particular accounting period, irrespective whether these have been actually happened or not. And it is based on the premise that some right has arisen. If some expenditure has become due for payment, it should be made. If some income has become due for receipt, it should be accordingly recorded. What is the impact of this concept? The impact is provision is made for an expenditure to be made whether actually incurred or not. If some expenditure has become due to be made, it will be made whether actually incurred or not. It will be accounted for. Now, realization concept. Realization concept is just opposite of actual concept. In case of realization concept, revenue is treated as earned or realized on date when property in the goods pass on to the buyer and buyer becomes liable to pay. If a company has received some revenue, it will take into account. If company has made some expenditure, that also will be taken into consideration. What is impact? The impact is the future income is not taken into account. And similarly, goods sold on approval basis will not be included in the sales. Rather, these will be recorded on cost basis. Practice adopted by a firm for revenue recognition will determine whether revenue should be treated as received or yet to be received. So, accrual is a concept which relates to right to receive or obligation to pay, whereas in case of realization, it depends upon the actual receipt or actual payment. The next concept is a historical record concept. Friends, business transactions are recorded only when these are considered to have been completed. Sometimes it takes some time for a business transaction to be completed. It cannot be recorded till it is complete. Whenever it is completed, then it is recorded in the business records. And these records are maintained as date-wise. Means as and when these transactions are completed, they are recorded in the business books. And that record is maintained as date-wise. So that is called historical records. What is impact of this concept? With this, preparation of historical records is possible. So events relating to a particular account, when they happened, so that is very much possible when historical records are created. When ledgers are prepared, Then there is a historical record. Future transactions cannot be identified and measured accurately, hence these are not recorded. And friends, the last concept is the matching concept. It refers to relationship between certain cost incurred and revenue realized. Whenever some cost is incurred by the business organization, it is expected that it will lead to generation of some revenue. And the matching concept refers to the relationship between these two. Income of certain period is matched with the expenditure of that accounting period only. It's not like that income relates to some other period and expenditure relates to some other period. What is the impact of this? Whenever final accounts are prepared, certain adjustments are required to be made. These adjustments can be in the form of prepaid expenses, in the form of outstanding expenses, in the form of accrued income or accrued expenses, and these adjustments are made in the final accounts. Similarly, the concept of deferred revenue expenditure also comes into picture because of this concept. Well, friends, this was all about concepts as regards conventions. So that part we shall continue in the next lecture. Thank you, friends.